Welcome to Conversations with Frank Fabozzi. I'm Frank Fabozzi. This series is brought to you by the CFA Institute Research and Policy Center. Today, our conversation will be a panel discussion focused on developing and employing financial models within the asset management industry. We're fortunate to have us three experts from the field: Igor Yelnik, who's the CIO and CEO, and I know I'm going to butcher this name, Igor. It's called
Alphidence Capital.
Is that it? Say it.
Alphidence.
Alphidence, okay. Capital, which I assume you creatively made this up from Confidence in Alpha? Is that?
Yeah.
Okay.
Yes, I made it up, yes.
Okay, so you're the marketing guy also. Alexander Rudin, who's the managing director and global head of multi-asset and fixed income research from State Street Global Advisors. And Alex has been a regular on my panels and a regular in contributing to, a very important contributor to the Journal Portfolio Management. And then Suhail Shaikh, who's the CIO of Fulcrum Asset Management. Their bios and information about them are actually available along with this video. Today, together they bring extensive experience in portfolio management, risk assessment, and market forecasting. And what we're going to discuss is a range of topics: model development process, challenges in implementation, the impact of emerging technologies and regulatory considerations and future trends. So let's kick it off with model development process, and let's go right to the fundamentals. And I'll go to you, Alex. Could you share your approach when developing a model? Do you begin by defining an economic relationship before testing, or does it work the other way around for you?
Well, in almost all cases, we start from the economic relationship. You see, I'm dealing mostly with macro data and signals. The amount of data is not huge. If you start from a empirical relationship, you may find things which are simply not there. So we always try to go from the economic relationship first and then proceed with tests. That said, there are some really limited or special situations where that is not the case. For example, just like experiments in physics, an experiment may trigger some new economic understanding. Let's look, for example, what's happening with bond trading. Everybody knows that there is momentum in bonds that sort of has forecasting power. But if you go shorter term, you will see some elements of mean reversion. You cannot really discover it from economic relationship. It's difficult, but you can see it in the data, and sometimes it helps you build a better model. So to summarize, in most cases, from the economic relationship. But if you get lucky, in some selected cases, now the data also can teach you something.
Well, let me mention Alex has a PhD in physics. Okay. So to him, this is sort of simple. Should I say it that way, Alex? But yeah,
we do, in fact, a lot of. I think there could be made a lot of analogies between the physics and finance. So yes, some lessons we learn in physics we carry over to finance very easily. That is true.
Yeah. Does anyone want to add to that?
Maybe I just add one quick thing. This is Suhail. So we also look for economic relationships, some sort of theoretical foundation, which I would contrast to pure machine learning, which may just find something in the data. But there are relationships like there are risk premium relationships, and there are also market anomalies like momentum, which doesn't necessarily have an economic relationship, but it has a behavioral underpinning. And so I would classify that in the same area, as it's not something that we just find and believe. It's something that we actually understand reflects human behavioral biases that persist over time.
Yeah, look, quickly, what is your background? What was your undergraduate, graduate degrees?
So I'm probably the least quantitative here. I did a BSc in management from the London School of Economics. It's really a jack of all, some finance. And Frank, as I mentioned, I studied some of your work back then. I spent 5 years at Goldman Sachs working in portfolio construction and asset allocation. And the last 20 years, I've been a discretionary trader here, but using quantitative methods to trade on a discretionary basis, as well as overseeing pure quantitative models. So I'll bring a slightly different, less academic, definitely no PhD lens to this, but hopefully some pragmatic conclusions.
Thank you. Igor, considering the difference between, let's say, research and production, how do you approach the system and software development for your models?
From us, it all starts from the understanding what kind of product we want to build. And we are an institutional quality asset manager. It's an institutional quality asset management product, and it must be supported by the institutional quality software product. And when we think about our software development, we're thinking about it as if we are building a product for a third party. So it should be high quality product, which should be the portfolio manager, its user, should be able to use without any hiccups. And this means that we invest a lot in software development. We employ professional programmers. We employ professional quality assurance engineers. So this is a proper system with proper user interface and so on. Now, when you are a researcher, sometimes it's very tempting to write a very quick Python prototype and get your results very quickly, and it's absolutely fine, and we do that. And then the question is, how do you transfer your prototypes into the development, into the production environment? And sometimes it's better to recode the whole thing. Sometimes it's better to test it properly, make sure that the Python code works nicely, and incorporate it into the production system. But it's always, regardless of whether the code is written by the professional programmer or by the researcher, it should always be tested. It should always undergo the same acceptance procedure.
Look, quick, what's your background?
I have a degree in computer science.
Computer science. Okay. All right. Let me go to Suhail. How do you integrate qualitative insights with quantitative data in your modeling process? Do you weigh one type of data more heavily than the other?
Sure. So as I mentioned, at Fulcrum, we manage both purely discretionary strategies as well as purely quantitative or systematic strategies, all within the same team, and the heads of those teams are all part of our firm-wide investment committee. The reason I mention that is the discretionary folks bring various bits of market-level expertise, and the quant teams bring a lot more of a solid, robust framework for the discretionary thinkers to actually make their decisions. Many of our models actually started off as monitors or tools built for discretionary people. And over time, they became systematized versions of what we've done for years anyway, but probably in a less rigorous, less robust way than a machine can do it. We continue to use them, but the machines really started with those discretionary insights. And that's the main way that these embryonic ideas have turned into models. And this goes back to your prior question. We're not just searching the data for something that works. We're using our economic knowledge and intuition to develop models and then purely systematize them. The way I think about it is I'm actually quite agnostic between discretion and systematic, much to the annoyance of both of those two camps, I guess. But I see as essentially we have two sets of humans at the end of the day. We have humans who are doing all of their research. Many of them are very quantitative, but ultimately I put them in the discretionary bucket. They're coming up with their research, and the discretion is about the implementation. It's using their judgment, their agility, their trade structuring to create the best expression of the trade. We then have separate humans again who are researching, putting all of their research into quantitative models and then delegating to machines to trade. So both sets of those humans, at the end of the day, they're no machines that are actually driving the insights. The insights coming from people. And both sets of those humans have full access to each other's predictions, insights, and so on. And that's really how we get the benefits of these two quite different approaches. But ultimately, when it comes to trading, the reason I like models is they don't have the same behavioral biases that we may have as humans. So once it comes to the actual trading, I want to preserve the independence and the objectivity of the models and let them really run as they see fit. There are specific instances, but they're rare, where we may have to try and intervene. Pandemic, maybe we'll discuss later, when suddenly there are structural breaks. But really, that we try and provide the insight at the model design phase, and then we do not interfere in the implementation phase in real time, just because as discretionary traders, we don't like the positioning.
Thank you. I'm going to throw this question out to anyone. I hope all three of you can contribute. How do you decide on optimal complexity of a model? What guidance do you follow? If you do any following guidance at all, keep the models adaptable without overcomplicating them.
If I may take it first, simpler models are in general better than more complex models, unless this complexity adds you something which a simple model can't do. So if I have two similar models, one is simple, another one is more complex, I will prefer a simpler model. Now, the question is how to gauge where this complexity becomes, too much of a muchness. And I think it comes from intuition, from experience. I remember making a lot of mistakes trying to do things in a more complex way, in a more elaborate way, to use more complex mathematics. And then eventually it turns out that a way simpler approach gives the same or even better results. And typically simpler models are more robust, more reliable, and yeah, as I said, this is a strong preference, and it comes from intuition and experience to a large degree. Of course, one can, again, overcomplicate things and try to sort of automate this sort of search for complexity, but I think that's, again, too much of a muchness.
Yeah. Anyone else?
Shall I jump in quickly, Alex, or would you like to go first? So if I can requote again somebody much smarter than me, everything should be made as simple as possible, but no simpler. That's the broad guidance that we try and use. So we're trying to be complex where necessary, where justified, but by and large, agree with Igor. Simple is genuinely going to be more robust. I think I'd love to say a little bit about overfitting is the obvious problem with complex models. And we try and get around the overfitting by really letting the data speak. If the data is relevant in the history, acknowledge that the history is just one subset of what may actually happen, but give it a weight based on its effectiveness in the past as opposed to your belief that it may be effective. But also, I think underfitting can be a problem. If we go too simple, we may miss other dynamics, macro factors, interest rates, inflation that drive asset prices. So it's really a balance between the two. I'll give you one example in practice. We do many things in our quant strategies. One of the many, and it's probably less than 10% of what we do, is trend following, but a pretty well-known commodity trading advisor trend following type strategy, where we're a little different to many, where we use a single speed across all markets. And so the backward-looking window that you'll be modeling to determine the trend is the same for the US 10-year bond as it is for cocoa, for example. And we did an exercise, this is probably 10 or 12 years ago, where we said, okay, let's move away from that simplicity and let us backward optimize the best speed for every asset class. And let's backward optimize the best speed for cocoa and oil separately within commodities. And then you repackage the whole thing better, and the aggregate result barely improves versus the average. So that's an example where all of that complexity, even if it improves the Sharpe ratio backward looking or the drawdown characteristics, it's just not sufficient to justify the level of complexity and overfitting involved.
Okay, good. Alex?
I'm violently agreeing with both previous speakers. So I think your quote was from Einstein, I believe. It was paraphrased.
Yes, exactly.
But you're absolutely right. Like I also strongly believe that each additional level of complexity must be justified by some measurable improvement or by capturing some new phenomenon, economic intuition that otherwise was not there. Otherwise, if you cannot justify additional complexity, I just don't use it. Maybe also a personal preference. I prefer generalized models more than I like sort of specialized models. but it's just maybe me. For example, I don't know, you can look at the interest rate effects on equity sectors. And what you can take a position that each sector has its own interest rate sensitivity in financials more than in industrials, for example. Or you can try to build one. So then you will have a dozen separate models, each customized to a particular sector. Or you can try to build a generalized model which applies to all sectors at the same time and treats them on a relative value basis. Personally, I would very much prefer the second approach, which is exactly what we do. But anyway, we all agree, simple is good.
One of the debates that we often have internally, Frank, if I may, is it better to have a model that trades one asset with many, many different signals versus having a model that trades many assets using the same signal? And we try and do both, but if you've got 18 different uncorrelated ways of predicting natural gas, is that better than having 18 assets that you are predicting based on interest rate differentials? I don't think there's a necessarily an answer there. I know my preference, I'm, again, pretty agnostic to the number of inputs. I care about the amount of breadth and uncorrelated returns that the strategy ultimately provides.
Thank you. Let me ask, Alex, what role do intuition and experience play in your model development, especially when the initial data might not point toward a specific solution?
I would say they play a very large role. First, when approaching a new problem, experience helps to connect the dots, basically bring ideas from other areas, whether it's physics or another area of finance. And you cannot do it without experience. It's just hard. That's frankly why sometimes we sit in a meeting with a bunch of junior analysts and they all come up with ideas, and you immediately see which ideas simply will not work, while some others may have some legs. So it's a huge role of experience is also not just determining what to do, but what not to do. Either way, it's very important.
Well, let's move down from development to the challenges in actually implementing models. And we'll start with you again, Alex. You've noted the importance, well, in our discussions, you've noted the importance of managing implementation challenges. Could you walk us through some common obstacles that the obstacles in your strategies for overcoming them?
Sure, and it will be a relatively long answer. I apologize. There are really 4 types of implementation changes which are common. The first is client-related. Client places restrictions of type of instruments you can use, or say no derivatives, for example. That may significantly shrink things you can model. You cannot do leverage. You cannot not really do relative value much. These are, let's say, curve bets are out of the question. Many things you cannot do because the client told them the derivatives are just not admissible. So that's a significant handicap. Second is investment process related. For example, you only trade once a week. That's very typical for large institutions. We trade effectively once in 2 weeks for our tactical process. So that means that modeling short-term signals is out of scope. Third is capacity related, which is somehow linked to frequency, to be honest, because large multi-billion funds are trading differently than small funds. Much lower turnover is allowed. We are very much multi-billion, so we have no choice but to trade slowly. Finally, the fourth is related to how exactly we implement. Say you want to implement broad US large cap equity use. That's simple, right? There are a bunch of index funds or ETFs, that S&P 500, that allows you to do that. But for example, if you want to implement equity sector use, you will find that index funds for institutions, they behave substantially different than ETFs. In ETFs, they're subject to 40 Act rules. There are concentration limits. Therefore, there's a track. Let's say you cannot have as much NVIDIA or Microsoft than an index fund would. You just cannot implement the market weights. So as a result, you will have tracking error just from the fact that you cannot use full exposure. And that's very significant. And you have to take this into account. So we have to be careful when applying a generic model. We always try to see whether our generic model, for whatever, can be properly translated into the implementable instruments when we are thinking about implementation.
Okay, anyone want to add to that?
Yes, I've much broadly agree. I think one thing that I found in practice is that it's very important when you are building a strategy and then investing client money in that strategy that you try and put yourself live through that backtest. It's very easy to put together a backtest. It works for 20 years or 30 years, and you know ex post that it starts over here and it ends up over there. And whatever path it takes, it's very easy to become complacent that you would have held it. There are many times where we will start a model and it has a drawdown completely consistent with its path, but there's a lot of panic at the time, especially in research, about whether you can hold the model or not. So what I like to do is almost live day by day, maybe even intraday. It might be that you live through the day, but intraday you would have actually said, I can't take this anymore, and intervened. So living through it is important. The other thing I try and do, and often it can act as a slight safeguard against this, is I like to double all the drawdowns, double all the weekly bad weeks and the bad months, because quite often the backtest, however honestly you try and do it, it's typically 2 to 3 times inflated, would be my experience, versus what you may expect forward looking. And one way to try and correct for that is increase the drawdowns and then put yourself again through that live experience if you can, and you're more likely to stick with those models in the future.
Yeah, I would agree with that. Backtest, however experienced you are, you will still have some selection bias. It's unavoidable. It's absolutely unavoidable. And as much as, you know, I fight it, and I fight it as much as I can with all the experience which I have. But nevertheless, even with this experience, when I have an information ratio, sharp ratio, whatever you want to call it, in a backtest, I tend to divide it by 2. And this is my expectation for real life.
Okay. Igor, let me stick with you now. Data are often central to model efficacy. How do you handle challenges related to data selection, storage, cleaning, and testing?
Well, it's one of the essential pieces in what we do, right? Because everything we do is based on data. So we have a central database. We have specialized software which allows us to clean the data. Thanks God we're not trading intraday, so we don't need to make this process completely automatic. But it's a great tool for a person who is responsible for cleaning the data. All the outliers are highlighted, all the data which is supposed to be there but is not there is highlighted, and so on. So this process takes, if everything is reasonably okay, maybe 10 minutes a day. But if some data is really wrong, it's coming from this data supplier is wrong, then it may take hours to make sure that the data is correct, because the supplier has to correct the data and so on. Now, the data doesn't always come clean. And this is one of the assumptions which we always make. With regards to testing the data, I'm not sure I really like this modern speak in the quant management industry. We don't test the data. We test signals which are based on the data. And data itself, I mean, do you have any signal in the GDP data or in money supply or in current account data? I don't know. We managed to find one in each of these, actually. But when you just look at the data, you can't say whether there is a signal there. And again, getting back to an earlier point discussed both by Alex and Suhail, we start with an idea. And if I believe that, for example, changes in money supply can forecast bond returns, I don't start with data. I have the idea. And then when I know that, let's say, M2 money supply is going to be useful for me, I will find that data.
And this is for anyone who wants to answer. When a model doesn't perform as expected during implementation, do you ever override it? And if so, what factors justify overriding it? Anyone?
Yep, sure.
Okay.
To me, it's very important to define the trading universe. The trading universe of my model is futures and currencies. My trading universe is components of my strategy. So if I include a component into my strategy, that's my trade. If I exclude it, it's my trade. If I reweight it, it's my trade. But I'm not going to trade individual, let's say, S&P futures or dollar yen. It's not my business. It's the business of my model. So if something underperforms, if some component of the strategy underperforms, is it enough to make a decision about downweighting it or excluding it from the strategy? And that begs the next question: what it really means, to retire a component from the strategy? And for me, the answer is very simple. If today I wouldn't include this component into the strategy in the first place, it shouldn't be in the strategy. I will exclude it then. But I don't do this analysis just based on the signal underperformance. We do it once in a while. We review the model once in a while. This may be once a year, once every 2 years. Again, when you build a model which takes macroeconomics and fundamentals into account, which is very slow by nature, you don't have too much information. The effective number of trades which you make is not that large. So it's not your high-frequency trading where 3 months of data tells you a lot. In our world, 3 months of data will tell you virtually nothing. So we have to be patient when we include a component into the strategy. We assume that we're including it forever. It will stay in the model forever. And then we may reconsider in a year or 2 or 3 or whatever. But it doesn't happen because the component has underperformed for 2 weeks or for a month or for a quarter.
Thank you. Let's shift to emerging technologies and again kick it off with Alex. What are your thoughts on the distinctions and roles of machine learning versus AI and asset management?
This is a very hotly debated topic. You can go into any management meeting here at State Street. This is what people discuss. The phrase artificial intelligence is used so loosely these days that we really cannot define what it means. I have to say, I will have to start from that. So I often think of AI and ML as interchangeable in a way, with AI as a sort of new fashionable version of good old machine learning. That's my philosophical position on the subject matter. Machine learning, however, is an umbrella name for a broad variety of clever data science techniques that go beyond the regression and sort of hardcore numerical methods. And by the way, many of these techniques are far from new and have been used by asset managers or generally in finance for a very long time. I actually looked it up. Market chains, 1906. That's when they were invented. They are often used, including us, in situations where they have regime-driven investing. They're very helpful sometimes in those situations. Neural networks, they were actively pursued from 1960s, and sometimes people use them to model adaptive processes, even now in finance. Lasso ridge regressions and things like random forest, we're talking 1970s and perhaps 1990s. We use them as sparse regressions, for example. Routinely, they're used in asset management when the problem is you're trying to minimize number of variables in your problem. So yes, they're used extensively, but they're not new. Stochastic gradual descent, 1950s. That's a portfolio management, portfolio construction technique. It's portfolio optimization technique that could be used for such purposes. So all these things are very well-established methods used within finance for a long time, and we use them too, and perhaps other people on the phone as well use them. Generative AI is another thing entirely. It's not a method, but a set of interactive tools. It may be used as a really cool computer assistant, sort of assistant. in research, coding Copilot, a library, whatever. But it's a little bit too early to tell how it's going to be used in asset management because it's a really new thing. So I would like to separate ML AI generally from generative AI, which is a very specific thing, like ChatGPT type tools. They are not really tools to model things. They are tools to work with.
Maybe if I could just add, sorry, Igor, please.
Excuse me, before you do that, would you make sure you explain what you told me at the very beginning before we started this session about how you use, AI? Because I found that very interesting.
Okay, so the context I would say is that AI, as Alex has just said, is not new. What's changed is the computing power and our ability to use neural networks much more quickly. Things that would have taken us weeks, months, maybe even years can be done not necessarily in seconds. I mean, many of our optimizations still take 3 minutes, 5 minutes. There's a lot of nonlinear constraints being optimized against. So we have spent a lot of time and effort in the last 3 to 4 years developing techniques that I guess would fall into AI or machine learning, but really where we found the most impact is on the optimization side. So I'll give you an example. Right now, as a discretionary portfolio manager, some of the stress testing that we're doing on the US election, whether Harris wins or Trump wins, or there are a bunch of other shocks that we need to also consider. Chinese fiscal stimulus around the corner. We'll find that in a few days. You've got the Fed in 2 days. You've got a UK budget. You've got Middle East tensions, all these different shocks. There's so many nonlinearities, so many possible correlations that could emerge between stocks, bonds, the dollar, and so on. I think actually at the moment we can do some of that stuff in our heads. I can't do it in a machine. And sometimes we can't even explain how we're doing it in our heads. But where we're getting benefit. So let's say we have 15 different uncorrelated quantitative models, each of which has a backtest over a 20-year period, each of which has a sensitivity, let's say, to stock markets of X. How do we combine model 1 to N together if the total can't have a beta on a forward-looking basis to equities of more than Y? Well, if you simply use old techniques, you'd look through those histories and sum them up in some sort of linear way where you end up not making a breach on leverage, on beta, on volatility, whatever it may be. What the AI techniques have allowed us to do is to take a much more distributional approach. Your backtest is from a subsample of a history. It's one history out of many. It's a sample out of many that could occur. And by simulating that way of modeling for each of those submodels, you can have a distributional conclusion to say with 95% confidence, this weighting system of various models will never breach your leverage limit, will never breach your vol target, your drawdown limit, and so on. And that's really where I'm most excited. It's in this optimization world as opposed to using AI to read Fed text. We've done it. We're finding some interesting things, but it's one of many, I would say, early days options on making money that I'm not sure are yet proven.
Yeah, Igor, before you mentioned signals, what has your experience been with incorporating third-party signals into your strategy? And how do you determine whether to trust an external source of information?
I have been very careful about incorporating third-party signals. I have a fiduciary duty to my clients. The provider of a signal doesn't. This makes quite a lot of a difference. So if I use something, I need to understand how this something has been produced. When I get data, I understand how this data has been calculated, what methodologies have been used, and how it ends up in my database. With regards to the signal, if I don't have the access to the data, to the underlying data, if I don't have the access to the code, then it's very difficult for me to see whether it's worthwhile. I don't know how it was actually tested, because eventually you are seeing the final outcome, which always looks shiny, but all the pitfalls which we have discussed on this call, when I control the process, I know how to avoid them. When somebody else controls the process, I'm not sure they have been avoided.
Suhail, how do you handle integrating alternative data sources, and what processes do you use to validate the data quality?
So maybe I start with a caveat that the vast majority of the models that we build use regulated data, publicly available data. It's the way that we deal with the data to create signals. It's the way we decompose the data where I think the bulk of our edge is. However, we do occasionally use alternative data. It's often unstructured. It's often incomplete, can be noisy, so it can be quite difficult to actually integrate. It may come on irregular frequencies. So there are definitely problems there. We've done that with our nowcast in the past, where we've got all sorts of different data to formulate a global economic nowcast, a US economic nowcast, and so on. So we're used to using Bayesian techniques to combine data that is irregular, infrequent, different frequencies with different lags, and so on. The types of alternative data we've used, some of the first were during the pandemic, actually, where suddenly, out of nowhere, there was virus data. And as the virus data was being released on, fortunately for most of us, we've forgotten about the pandemic now, but at the time, obviously, economies were shut. What the ISM was going to do didn't really matter because the global economy was shut. If I waited for the actual data to be released, we would have been way out of date. So actually the focus there became on higher frequency consumer confidence tracking data, spending data, lighting across different parts of the world to get an idea of activity, and the virus data. So we're happy to use new data if the old data becomes stale. It's rare and infrequent, but we're happy to use it. More regularly, we look at things like positioning data to determine crowded trades, short interest data from banks, from prime brokers to try and figure out which stocks have the biggest leverage shorting on them and so on. There's credit card data that can be used. So there's a bunch of this data. We also use climate data. To answer your question on validating the data, we're not the experts to validate the climate data, right? We're not the experts to validate the credit card data. It's more the way we try and do is take the most reputable providers of the data in the same way that you may take Moody's, S&P, and so on to get the high yield credit ratings. We're not going to do every company's bottom-up due diligence to figure out whether they got it right or not. We'll rely on the law of large numbers, make sure we're going for industry best practice, and find the data providers that are do the due diligence on the data providers, but then take it in. And like with any other data, it should be broadly accurate, but it doesn't mean it's going to work anyway. We wouldn't bet the ranch on any of that data. But really, we rely on the third parties to clean the data, and then we do our due diligence to make sure that they're doing a good job as possible.
Thank you. Let's now turn to regulatory and ethical considerations. And well, let's stay with you, Suhail. How do you navigate ethical considerations when designing models that impact large groups of stakeholders?
So this is definitely something that's come to the fore more in probably the last 15 years, especially with regard to climate risk. The first thing I would say is that we have many stakeholders, from partners and employees to shareholders and so on. We have many clients. And what constitutes ethical is normally reasonably black and white, but take something like nuclear weapons. There'll be some people, some stakeholders who think it's unethical to have nuclear weapons. And others will say, well, we have a Trident program in the UK, the US has a nuclear program, the government sanctioned it. What's this got to do with my ethics? So I think this is a really opaque area where different people's subjective judgments, it's very difficult to actually marry them together. So what we try and do is the following. We have a responsible investment committee whose job it is to debate all of these things, but ultimately give a black and white answer. This is something that I've been quite vocal about insisting on. Either it's investable or it's not investable. Nothing should be gray if you can avoid it. And then it's up to the modelers to build portfolios from the instruments that they have been allowed to invest in. i.e. it's black in this area or it's white in this area, and the other instruments are not allowed to actually build with. So specifically, the things that we've banned are cluster munition stocks, tobacco stocks. This is a function of our stakeholders' preferences at the end of the day. Predatory lending, but besides that, it's really mandate specific. Those bans are firm-wide. We have a climate change fund that has to buy physical securities. It has to follow stewardship and vote properly on all the climate-related issues. But in our macro future strategies, we're not doing that. So it's bespoke at the investment level, but there are some overarching exclusions that apply for the firm as a whole.
Yeah. Thank you. Igor, should market risk management be incorporated into the strategy that you may be formulated or kept outside as a separate function?
Well, risk management as a general concept has many facets, but if we speak about market risk management in particular, I think it better be incorporated into the strategy, because eventually risk management in a systematic process is about sizing your positions. It's about taking certain types of risk, and this is all part of the process. Everything we do is, in essence, manage risk. Yes, we can have those amazing, beautiful signals. We may have them uncorrelated and so on, but effectively, the way we size them in different market environments, in different regimes, depending on a number of various parameters, is what we do. And if there is some exogenous force which can say, okay, you know what, guys, now you have the risk for whatever reason, because we don't like your positions or we don't like something else, it's going to detract from returns in the longer run. So in my opinion, if you have the possibility to incorporate market risk management into the strategy, it's way better to do it than not.
Yeah, thank you. I made an error. I should have said market risk management. I think I left the market out, but thank you for catching that. Alex, given the regulatory landscape, what challenges have you faced in developing or deploying models across borders? And how do you stay compliant? I mean, I would imagine one of the interesting areas of AI is just trying to keep up with regulations in every country, because I would assume almost every week some country has implemented some type of rules of regulation that might affect model development.
I'm fortunate, Frank. I work for a global company, a large company, which has portfolio managers and product specialists and attorneys, most importantly, figuring out what regulatory requirements are. So frankly, I work with them all the time, and the way we approach this, typically I always ask them to convert all these regulatory requirements, something actionable, constraints on the strategy, for example. It's rise on what Suhail was saying. For example, U.S. jurisdictions, in European jurisdictions, people will have some, the climate metrics will be almost like table stakes. Not so in the U.S. In the U.S., if you start excluding things based on climate considerations, you will lose clients. So we, depending on what the regulatory requirements are by jurisdiction, we simply try to follow them very carefully. And it goes back to my original comment. There are client-specific, mandate-specific boundaries. Somebody defines them for me as a researcher. I try to stick to what I know better, which is modeling and economic relationships.
Okay. Well, have any of you encountered situations where a model had to be redesigned due to ethical or regulatory concerns?
Absolutely. Absolutely, of course. I have an experience of running a UCITS fund, and regulation in UCITS is such that you can't do everything you can do in a Cayman fund or in a managed account. And there are certain specific constraints which you must follow, and you have to make sure that your portfolio fits into those constraints. For example, there are some constraints on the exposure you can have to bonds, which to me don't, as a portfolio manager, as a risk manager, they don't make much sense. But that's the regulation. I have to follow it, and I do follow it by changing the composition of my portfolio, changing some settings of the strategy. UCITS regulation, for example, doesn't allow to trade commodities. Either you exclude commodities from your portfolio or you replace them with a total return swap, which will cost clients more. So I'm not sure if it actually protects them. But again, for me, this is regulation. For me, this is the law. I follow it.
Yeah. Well, when considering regulatory guidelines, do you see any conflicts that arise between innovation and compliance, particularly when it comes to integrating new data sources?
Well, sometimes you can see such things, and when you think about data, all the providers anonymize the data, and from the first glance, you would say, yeah, that's fine. I wouldn't be able to say to who this data belongs. But interestingly enough, when you switch from the United States, which is a large country, to some smaller jurisdiction like Holland, for example, or some other smaller European countries, sometimes you will be able to deduce who this data belongs to. Something happens, some large transaction happens, and you can understand who did this transaction because you know the market. There are not so many players. And in my opinion, all the data providers will follow the rules and the law without any problem here. But nevertheless, some ethical questions clearly arise.
Well, thank you. Let's wrap up and let's discuss future trends. Alex, we'll start with you. What do you believe gives a model a competitive advantage, and are multiple dimensions essential?
It's a very broad question, Frank, and just trying to be thorough, I can list many dimensions, perhaps 5. First, an idea. What an economic relationship we aim to capture. If somebody has a superior idea or captures something which nobody else does, which is difficult, it gives us an advantage. Second one is breadth. That's what I completely agree with Suhail. I also would take a model with which trades 17 markets, even with one idea. Instead of trading one market with 17 ideas. Why? Because you have much higher probability of success. So breadth is important. Third is method. How exactly are we doing the capturing? It's a dimension. I'm not sure it's always the major one, but in terms of competitive advantages, but it's still there. Data, what feeds the model in terms of information. As you were talking about breadth of instruments, you can also speak about breadth of informational sources. If you get some genuinely new information into your model, different from other competitors, that's definitely a plus. And finally, diversification of all of the above. We like a portfolio of good ideas more than one fantastic idea, because in our experience, this portfolio has to be more reliable. So uniqueness in at least one of those dimensions can bring advantage. It is really hard to be best in all 4 or all 5 at the time, but we, of course, try, all of us.
Could I answer that question? It's just a very headline, slightly different way, slightly more abstract, but I find it useful when I'm thinking about individual models or when I'm thinking about individual traders. So if we define the competitive advantage as the Sharpe ratio or the information ratio that you might generate over time in the future, and I'm assuming we're looking at uncorrelated models, so not just buying the S&P or buying duration, something that is a long-short alpha type model, then I try and summarize the competitive edge into one of 3 things. Either you have breadth, so Alex, you've talked about that, so lots of uncorrelated ideas of equal ability to impact the portfolio over a period of time. Two, you may have a hit ratio advantage, i.e. you just get more things right than wrong. And that could be data, it could be your trading style, it could be momentum, it could be risk management, whatever it might be. And then the third one is, are you able to generate some form of asymmetry in your returns so that when you implement the view, are you on average when you're winning bigger than when you're losing? And every edge for me is then put into one of those three. More than 50% hit ratio, greater than one asymmetry, or lots of independent bets. So each model I tend to view through that lens.
Okay. Thank you. Let's make the next 4 questions sort of toss up. Whoever wants to participate, fine. How do you anticipate the evolution of ESG factors? How will that affect model design and portfolio strategies?
I think eventually it boils down to what Alex has already said about client-imposed constraints. My job is to do what the client wants me to do. And if the client wants me to just make money for them without any without giving any consideration to ESG constraints, I will do that. If the client comes to me and tells me, you know what, the first thing you have to do is to think about ESG constraints, I will do this. I have my own ethical considerations, which I will never breach, regardless of what the client tells me. I will better lose the client than breach them. But that's like standard black and white ethics, as Suhail mentioned. Speaking about other things, I think it's all about the investment mandate, which we get from a client. In general, speaking about the future, it's very difficult to predict the future as well there. But I have the feeling that the whole ESG thing is probably peaking right now. I think this fashion will be fading out of the investment landscape if we speak about the next, let's say, 5 to 10 years.
Okay. Anyone else?
I can only comment very quickly that I would just as Igor said, I also view ESG factors not as factors, because factors assume that there's some premium associated with them, but more like limitations. They're more limitations than strategies. And everything he said is more or less how I feel as well.
Maybe a 10-second addition is that I expect greater continued pressure to invest in cash instruments. I'm not sure if that's necessarily a good thing or bad thing for returns, but it should allow. So we're under constant pressure to vote on the stocks that we own rather than own through futures. And that's something that in various parts of our business we have actually done. I suspect that will continue, so that people with capital can actually influence the companies in some form. And I wouldn't also be surprised if certain instruments or certain countries were just excluded on ESG grounds at some point. We've seen that, unfortunately, with the geopolitical tensions that we've seen in Europe, but also perhaps it may happen in Asia. So I expect those two trends to probably continue for a while.
Okay. Well, what are your predictions? This is open to anyone. What are your predictions for investor expectations shaping future asset management models, particularly about sustainability and long-term resilience?
A quick couple of comments. I think and Igor highlighted this slightly, most investors, historically at least, have focused on return and risk, so some form of risk-adjusted return. And over time, there's been a broadening of the utility function to focus on so risk-return correlation to other assets, and now ESG factors or climate change or whatever other utility function somebody may have. I think every additional component in the utility function is an additional constraint over the long term. And we're seeing this already. Igor's highlighted it. When investors end up having lower returns or higher risk, but a more sustainable portfolio, I think very quickly they realize, or most realize, what they really care about. I've seen this in practice. It doesn't happen across the board, but I don't think it's clear that you should expect a more sustainable investment process that has the same expected return and the same drawdown profile and risk profile. I think there is a trade-off.
Yeah. The only comment I would like to make, because I don't have a strong view on this, is that there is a mismatch in type horizons between the sustainability goals, objectives, even measurements, and typical investment horizons. Like we invest over a month or a year, 3 years. All these sustainability goals, we're talking about 50 years from now. And the uncertainty associated with all these predictions is huge. Modeling liberties are massive as well. So it's very hard to put it together. We could do it through limitations, just hard limitations. I don't do this, I do this. That is fine, that's what's happening.
How do you anticipate the asset management modeling field will evolve over the next 5 to 10 years, and what should we be prepared for?
Well, if I may start, I think that what we have been seeing in the last maybe 10, 15 years or so has been a trend towards faster models. And it's very clear why this is happening, and I think that that this trend will continue. People, when you trade a faster model, in theory, at least you can get a higher Sharpe ratio. People are willing to sacrifice capacity in many cases and get a higher Sharpe ratio strategy. Not always, thanks God, but nevertheless. And I think now we have a generation of people who have never traded on screen, certainly not in the pit, and probably not even traded themselves at all. They're just quant researchers. And 20 years ago, I had to explain to investors that quantitative management has the right to exist. Today, there is an army of people who know about quantitative management way more than I do. And they all build models, and I'm competing with them. And they're all trying to build. I have to be competitive, nevertheless. So what can I do better than they can do? I mean, if they all focus on faster models, which will have a relatively high Sharpe ratio, but a relatively short shelf life as well, because there is an arms race going on there. So I will have to do something else. I will have to be competitive. And I think that what Alex is doing is also, quite slow and quite different from what the majority of the industry is doing currently. Nevertheless, what is happening there in this arms race on the short-term spectrum of asset management is going to continue. And the next really big thing, like the next quantum leap, will be the invention and productifying of quantum computing. Sorry for the pun, it was completely unintended. This will bring a different level of computing power, the possibility to calculate things which are incalculable today will increase, and who knows what it brings along. I don't know the answer to that.
I think undoubtedly you have more computing power. They'll be chasing the same returns with just faster and faster computers. I think it'll become harder to exploit alpha. Many of the things that we all do will have a tendency of being commoditized, so we'll have to keep innovating. But ultimately, models are reliant on the past, and the future will be different. And so I think no matter how much computing power we throw at problems, models will continue to fail. There'll be stable periods, and then there'll be explosions in volatility. I don't think anything dramatic will change in terms of the overall market. I don't think everyone will suddenly earn the risk-free rate. Hopefully there'll be an industry for all of us still.
I would maybe add a comment which is a little bit different from what both of you made, because I was looking at this question, I would be looking at this question more from business perspective. Like what's new in asset management over the next 5 to 10 years? Mass customization, especially wealth channels. That's a new challenge. You guys run hedge funds, basically, so you don't have to deal with retail distribution. We do as a part of global asset management firm. Currently, asset managers, they create solutions for large cohorts of clients. Let's say low risk versus high risk. Well, that's changing. There's an increased tendency to explore solutions designed for an individual, or at least a very small cohort. We have dabbled with it when it comes to retirement solutions. But as we progress, it's very clear to me that you will have to do it for all types of investment solutions. Build models which are customized on a very, very detailed level. That's tricky because it brings data challenges. It probably requires very sophisticated objective functions, machine learning type optimization that Suhail mentioned before. We also developed it as well here because that allows us to solve problems without being constrained by quadratic optimization, basically. So need for higher automation of investment decisions on a mass scale, like thousands, tens of thousands of simultaneous accounts. That's one of the challenges also which worth mentioning, I think.
And I think technology will allow almost infinitely bespoke portfolios in a infinitely scalable way, because you're still trading very liquid assets, stocks, bonds, commodities, maybe credit and cash. So we've actually trained some of our resources, some of our research. One of the big focuses is on the asset allocation side, because what we do in hedge funds as a macro quant firm or as a macro discretionary firm is really quite niche. It can't really change the asset allocation or the outcome of a big superannuation fund or a big pension fund. What can change, or for that matter, retail investors, what can change their experience is getting the dynamic asset allocation or strategic asset allocation right. So that is an area, and we should definitely talk, Alex. It's an area that I think is very interesting, and we will see a significant application of this probably in the next decade.
All right, my closing question. Do you have any thoughts on how new generations of asset managers can be prepared to meet the evolving demands of model development and application? Anyone?
One thing I would say is that I'm already seeing this within our own research team. We are using large language models. It's almost, whether it's Microsoft's Copilot or other tools out there, getting the machines to do the basic coding and then helping that code or finessing that code with humans is definitely happening. And I'd say that is having a significant impact on productivity and speed of coding. It's being commoditized. So I'd expect that to continue and for people to harness it.
Anyone else?
I have a couple of points, if I may. And it's almost like a parental advice. And we do mentor a lot of junior analysts, and that's what we preach to them every time we speak with them. So first of all, efficiency. And that's right with what Suhail was saying. Make sure your modeling and implementation processes are efficient, because inefficiency is like an iron tied to you when you're swimming somewhere. It will drown you, or at least you will spend all your energy on fighting those inefficiencies. ChatGPT perhaps is one of the ways to improve efficiency, but there are other ways as well. The second one, it's not just State Street talking, but it's actually my personal conviction as well. Be fee conscious, meaning that fees directly subtract from outcomes, and most managers perhaps are not worth their fees, or at least not worth all their fees. So understand drivers of managing returns before you actually invest, and a little bit before what's non-trivial. It's the general comment, which is important, I think, in asset management. And finally, asset management or just modeling is not easy. So decide what area you would like to excel in and delegate everything else to somewhere else. Perhaps that's a general advice.
Yeah, I would say that this has been a very difficult business always, and it requires some patience, some stamina to stay with positions which are very uncomfortable, which other people may not necessarily like, which may think that you are a complete idiot, but nevertheless, you have to stay with those positions, and this may be very painful. Not everybody can do it. Another thing which I would say is that it's very useful to start with basics. When we start studying physics, we're not starting with the theory of relativity. We start with Newton's law, right? I think it's very important to do the same here. And we need to understand that when we build those super sophisticated models with the super computers, we still trade the same markets. and it's still the other guy on the other side of the trade who also thinks that he's doing the right thing. So you need to understand why you are on the right side of the trade and not him. So I think those basic things are hugely important, and I wish all people who are entering this market understood that.
Well, thank you all for sharing your insights and expertise with us today. I hope today's discussion has provided our audience with a deeper understanding of the forces shaping the future of financial models and asset management. Thank you.
Thank you
very
very
much.
much. Thank you, guys.
For having us.